IBC is going to help you grow your money faster by running things through a policy.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso, and I'm excited. Today's conversation is really going to be about people that are new to IBC, and they're kind of wondering, hey, should I do it or should I not? And the other crowd is those that are doing IBC but may have heard some feedback from other people about, hey, you should be doing something else, right? Maybe your parents say you should be in the market. Maybe your brother's best friend is telling you should buy real estate, right? And so this is what today's conversation is really about, right, Anthony?
Yeah. We may have heard the term buy term, invest the difference.
So what does buy term and invest the difference mean?
In essence, it means instead of buying whole life, you buy term, and whatever the difference in the premium is what you invest with.
Yep. So today what we're going to be doing is we're going to be talking about kind of this comparison between buy term and invest the difference, but we're going to be talking at a pretty high level on this podcast. Is we're going to share some numbers, but we're also going to have a video that we're going to share that really dives into the numbers, and Anthony's kind of provide us a spreadsheet, right?
Yes, it's a pretty nice spreadsheet. Right?
Awesome. All right, so Anthony, so let's dive in. Tell me about the phone call that you received from the client.
So this client called me. He had paid the first year's premium, and the second year premium was due. And he reached out to me. He's like, you know what, Anthony? I'm thinking about canceling this policy and getting some term insurance because I want to protect the family, but I want to invest. I want to be in the market.
And when you got that phone call, what was your first reaction?
My first reaction is he's not getting it.
Yeah.
Right? IBC is not put your money in life insurance or the market or real estate. Like you said, IBC, this is an and, right? We want you to invest in things that you know, right? And what I will say, to be clear with this client, I would call him a true investor.
Okay. What do you mean by that?
He's not a lot of people who say that they are investing are just buying mutual funds or just blindly investing in the market. This guy took a training course. Like, he researched how to analyze companies, and so to him, he's being a true investor.
Yeah.
Right. And I also commend him for talking to me about it, about how he was feeling, because I know a few clients that had the same thought process that he was doing, and just never called me and just canceled the policy. But this just shows the character of this guy is he wants to learn.
Yep. Right.
So he's open to new ideas.
I've had this phone call before previously as well, and what you've got to do is, like you said, is you got to take them back. There's a misunderstanding, and we've probably had this conversation so many times, we've actually created a video on it, right? It's called What is IBC, right? Is that right?
Or How IBC Works.
Thanks, Anthony. It's called How IBC Works, and really it kind of lays out the fundamental understanding with IBC, which is that IBC is a cash management system. This is not the investment. And so when you get a call like this from an advisor's point of view, what we're doing again is we're just reiterating that the policy is the holding account, and then the investment is what we move into. So when this guy calls, Anthony, I'm gonna make an assumption here. When this guy called and you started to look at his policy, what was he looking at? He's looking at his cash value at age 65. Would you agree?
Yeah.
And how much cash value did he have at age 65?
He had $1.5 million.
Right.
And let me just give a little background. I think he's about 35, 36.
Okay.
And he was putting in $20,000 a year. The first year he put in a little bit more. I want to say maybe 10,000 more.
Okay.
Okay. But again, he was putting in $20,000 a year.
So he's fun. So I can assume he's looking at this thing and he's following the schedule down and he's looking, man, at age 65, I'm going to have 1.5 million is what you said. And then he's comparing that to investing in the market, right? At a 10% return. Did you do the math on that? What would that end up being?
Well, so what I did when I did the math, I got some of the numbers from him, because one of them is what is your rate of return that you would expect? So we have to put something in there. And he told me 10%.
Okay.
That he's never had a year less than 10%.
Okay.
So I asked him, since when?
Good question.
Right. And I think he was doing it for about 5 years.
Okay.
But you look at where the market's been in the last 5 years, I mean, it has gone up.
Yeah.
Right. And so the old saying goes, a high tide rises all ships.
Mm-hmm.
So I was being a little blunt with him, just because, he's open to it. I'm like, everything's going up. So you got to realize some of it is your experiences. Some of it is just what the government's doing and inflating the stock market.
Yep. So when you ran the math out on that,
mm-hmm.
what did that amount to? What was that number?
Well, what I think he was looking at, well, hey, if I put 20,000 away and I can make 10%,
yeah.
If you do the simple calculations there, he's going to end up having $4 million.
That's a big number,
right? So he's probably comparing. Well, shoot.
What it just came to my mind is 1.5 versus 4. That's a no-brainer.
Yes, exactly. Right. Okay.
Was that the full picture?
No. And that's why we say that we do the math, because we have to take it into account of that 20,000 or whatever the premium is. He's got to pay taxes on the gain.
Mm-hmm.
Okay. But he also has to pay a term insurance. And when we calculated that, and we use a tax rate of 22%.
Okay.
Again, we have a more in-depth video, so I'm going to try to keep things at more of a high level. But when we backed out the term insurance and what he had to pay the IRS, we had $2 million.
Okay. So let me just catch up. So if he were to leave all his money in the policy, he's got 1.5. If he cashes it out and puts those same premiums, those same dollar contributions into the market with taxes and fees, he ends up with $2 million, right?
Correct.
Perfect. That's a no-brainer. I'd still make that move, right?
Right. Yeah.
Yeah.
But the thing is, just as you mentioned earlier, this isn't an either or. This is an and asset. So then what I did is I calculated, well, what if he took a max loan every year, and then he put that into his investment account where he earned 10%, where he also paid taxes.
Okay.
Right. Yep. And since we're using a policy loan, there's going to be interest that we need to pay on that loan. So we calculated that as well.
And what did that number end up being, Anthony?
What I did when we calculate all of that and then eventually paying off the policy loan at age 65. So thus we still had the 1.5 million inside the policy, but he also had an additional 1.5 outside the policy. So he had a total of 3 million.
Okay, wait a minute. So you're telling me that if he just put money in the policy, it was 1.5 million.
Correct.
If he put money just in the market, it was 2 million.
Correct.
If he takes that money, those premiums, pays the premium, and then max loans it and makes that same investment, he ends up with $3 million.
Correct.
That makes no sense to me. Same dollar amounts, but he ends up with $1 million more.
Right. At first glance, it doesn't.
Yeah.
Right. But we have to look farther. We need to remember, when we take a policy loan, we're not taking it from the policy. We're taking it against a policy. Mm-hmm. We're actually borrowing from the insurance company, and they're using your cash value as collateral. So what that means is your cash value is still growing even though you are using it. So why we have so much more money is, for one, when we're by term invested difference, the most we put into our investment account each year is $20,000. Okay. But that's not the case with using infinite banking, because remember, that policy, that 20 grand a year, that cash value is continuing to grow. So full disclosure, the first 3 years, he's able to invest more money in the buy term invested difference because he's putting in $20,000 a year. But in the first 3 years of this analysis, he doesn't quite have $20,000 inside the policy. And without getting more detailed into it, there are some startup costs. There is a slow start is what we say when we're starting a policy. So thus, if you're focused on the short-term results, then do not do this, right? This is not for you. So at the beginning of this race, he's behind, right? But he catches up in year 4. And then he blows past him. And the reason being is because that policy is continuing to grow. And eventually, in that 4th year, it's growing by more than $20,000. Thus, when his policy loan and what he puts into his investment account is more than $20,000. Like, for example, at year 10, he's putting in, with the growth, he's able to invest $30,000 a year. But in buy term invested difference, the most he can put in is 20. Then in year 20, he's able to put in $50,000.
Man. So
in that year, he's investing $50,000. But buy term invested difference, he's still stuck at the $20,000. And in summary, what we did is we never broke the compound interest curve. The money inside his policy continued to grow even though he was using it.
That's phenomenal. Those numbers are huge, and they're almost a little bit unrealistic, right? So if you guys are listening, I urge you to go watch this video that we're going to create for this and where we dive into those numbers. So just to kind of recap where we're at is at age 65, by funding a policy, right, and then max loaning it and moving into that investment, he ends up with $1 million more, right? Mm-hmm. Anthony, does it have to be the market that he takes a loan and puts money into?
No.
What else could it be?
Nelson calls this the infinite banking concept for a reason, and I believe he uses infinite because there's infinite ways to use it. If you haven't read the book, I'd highly encourage you to do so. We will put in the show notes a link to get the book, but this can be used to pay off debt, right? To buy a car, but to me, I like to use mine to build assets.
Yeah.
So whatever that asset is, like what we want our clients to do is to invest in things that they know.
Yep, I was just going to jump in there.
And I beat you to it.
Did.
Okay. But whether it's your business, yourself, getting a course, this works really well with real estate, or it would be in the market.
Yep.
Whatever you know, IBC is going to help you grow your money faster by running things through a policy.
So real quick, we don't have to touch on this too much, but there's a couple other considerations that I think we should touch on before we wrap this up. At age 65, not only does he have $3 million or an extra $1 million by buying whole life and investing the cash value, what other considerations come into play at age 65 by having whole life in place?
Well, what happened to his term insurance at 65?
66, it's gone.
It's gone.
Yeah,
right?
There's zero.
But whole life, and Cameron, in case you didn't know, they call it whole life because it lasts your whole life. Okay? You're welcome for that. So they still have death benefit. And I know if you're listening to this and if you're younger than 65 or if you're in your 20s, you're like,
yeah,
I'm not going to need death benefit when I'm 65. But it was interesting. We actually had a meeting today with a guy who wants to join our firm who's ironically 65, right? And he's still working. His family is still relying on him because he's helping support his kids. Something happens to him, man, his family is going to be in a financial crunch. So even at 65, you're going to want some death benefit.
Absolutely.
And then another thing, and this would even maybe excite the 25-year-olds, is, really, Karen, why are people typically putting money away each year and not spending it?
To save for retirement, which what they want in retirement is they want cash flow. They want income.
Exactly. They want cash flow. The end game is how much cash flow I can make and I can take when I'm in retirement. So it's not necessarily what your net worth is, it's how much cash I can take out. And we're not going to go into this in the podcast, but because of the volatility of the market, it limits how much you can take out. Inside your policy, we don't have that volatility, so it allows you to take more money out. So we're going to dive deeper into that and those numbers in the video.
The video, you guys are definitely going to watch it, because some of the things that we do to create income, you guys are going to want to start to familiarize yourself with. I can't tell you how many times that I've had clients come in and we talk to them about different strategies other than just a straight drawdown, which just means you take out the same amount every single year. We're going to allocate, and because we got money in different buckets, we can increase somebody's income quite substantially. So you guys are going to make sure you want to go watch that video.
You know, one other thing that I think is important to understand that this actually pointed out to me is because he was willing to learn, because he called me and was open to hear this out, right? He's going to have an extra $1 million, right? So I would encourage you, if you ever have questions or think something isn't right, go ahead and ask questions and get some clarification. When in this guy's circumstance, that one question saved him $1 million.
Yeah, one phone call saved the guy $1 million. Pretty awesome.
While you're watching that video, one thing we don't promote ourselves much, right? We're just here making content. But while you're on the YouTube, I would suggest to like and subscribe to those videos, because we're going to create some videos, some content that's outside the podcast.
Yep.
And then also, while you're doing that, you know, it would really help us if you subscribed and you rated our podcast.
Awesome. Thanks, guys. Really appreciate you listening, and I know you're going to enjoy that video.
Go make it a fantastic day.
Take care.